Welcome to week 8 of Finding an Edge in the Markets. This week marks a major shift in how we think about stocks. We're moving beyond price charts, news headlines, and hype, and learning how to evaluate a company based on what it really is, a business. This session is all about fundamental analysis, the process of digging into a company's financials, leadership, and competitive advantage to determine its true health and long-term potential. You'll learn how to read income statements, balance sheets, and cash flow reports like an investor, and how to spot great businesses before the crowd does. We'll also dive into profitability ratios, management signals, red flags, and how to tie it all together with a full case study framework. Before we move on, if this content has been helping you build your confidence and sharpen your edge, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss a session. All right, let's get started. By the end of this session, you'll be able to interpret financial statements to understand a company's revenue, profitability, debt, and liquidity. Use key profitability and quality ratios like ROIC, ROE, and free cash flow yield to assess efficiency. Identify signs of a strong or weakening economic moat. Evaluate management decisions by analyzing capital allocation and insider behavior. Spot red flags that might indicate accounting risk, overvaluation, or structural problems. Apply a structured framework to analyze real companies and decide if they're worth further research. And finally, we'll ground this all in the Beyond the Chart segment, exploring how long-term thinking, resilience, and clarity make you a stronger investor. This week is all about learning how to look beyond a ticker symbol and evaluate the business behind the stock. So let's start with a simple question. What exactly is fundamental analysis? Fundamental analysis is the process of studying a company's actual financial performance, health, and strategy to figure out what it's truly worth, its intrinsic value. In other words, it's how we figure out whether a stock is a good business, not just a good chart. This involves both quantitative data, like revenue, debt, and cash flow, and qualitative insights, like the strength of leadership, the company's competitive position, and how it reinvests profits. Why does this matter? Because in the short term, the stock market is often irrational. Prices get driven up by hype, dragged down by fear, and tossed around by headlines. But over time, stock prices tend to converge toward the underlying value of the business. That's why Warren Buffett says, price is what you pay, value is what you get. And Benjamin Graham reminds us that investing is most intelligent when it is most businesslike. When you're doing fundamental analysis, you're not trading noise, you're investigating a business as if you were a part owner. Because if you buy the stock, that's exactly what you become. Now let's clarify how this differs from technical analysis. Whereas fundamental analysis looks at the business behind the stock, technical analysis is focused on price action and trading patterns, the behavior of the stock in the market. Fundamental analysis is long-term. Technical analysis is typically shorter term. You'll hear this phrase a lot. Fundamentals tell you what to buy. Technicals tell you when. Both tools are useful, but in this course, our foundation is built on understanding the business first. So what does fundamental analysis help you do? It helps you spot undervalued companies that are actually worth more than their current price. Avoid flashy stocks that are fundamentally broken under the surface. Develop your own investment thesis based on reality, not rumors. And ultimately make more confident decisions for the long term. There are 3 core pillars to every fundamental analysis: financial performance, which questions if a company is growing, profitable, and managing its costs. Strategic positioning, does it have a moat? Can it compete? Can it endure? Capital allocation, is leadership putting profits to good use or burning cash to chase growth? If you understand those three, financials, moats, and management, you're already ahead of 90% of retail investors. So with that, let's jump into a breakdown of the three key financial statements. Now that we understand what fundamental analysis is and why it matters, it's time to get into the tools. Every public company is required to report three core financial statements, and together they tell the complete story of a company's performance, financial health, and staying power. Let's break them down. First up is the income statement, also known as the profit and loss statement, or P&L. This is where you find the company's revenue, expenses, and ultimately its net income or bottom line profit. It answers the question, is this company profitable? You start at the top with revenue, the total money brought in. Then you subtract cost of goods sold, which gives you the gross profit. From there, the company subtracts all its operating expenses, like salaries, marketing, research, and development, to get to operating income. Finally, after interest and taxes, you land on net income. The income statement is all about performance. But performance alone doesn't tell you the full story. That's where the balance sheet comes in. Think of the balance sheet as a snapshot of a company's financial health at a specific moment in time. It shows what the company owns, its assets, and what it owes, its liabilities. What's left over is shareholder equity. In other words, it tells you how much of the company truly belongs to its owners once all debts are paid off. Two quick ratios we'll look at here. The debt to equity ratio, which helps us understand how leveraged the company is. And the current ratio, which compares short-term assets to short-term liabilities, a strong signal of whether the company can cover its upcoming obligations. Companies with strong balance sheets can survive recessions, make acquisitions, and avoid panic selling shares when things get tough. The third and often most overlooked, but arguably most important, is the cash flow statement. Unlike net income, which can be distorted by accounting adjustments, cash flow shows us the real movement of money in and out of a business. It's broken down into three sections. Operating cash flow, money from day-to-day business activity. Investing cash flow, money spent or earned from buying assets. And financing cash flow, money from borrowing, repaying debt, issuing stock, or paying dividends. What you're really looking for is free cash flow, which is operating cash flow minus capital expenditures. That's the true money the company can use to pay dividends, buy back shares, reduce debt, or reinvest in growth. If a company is reporting strong earnings, but its operating cash flow is falling, that's a serious red flag. So how do you use all three statements? Think of it as a triangle. The income statement tells you about performance. The balance sheet tells you about health. The cash flow statement tells you about resilience. Individually, they're powerful, but together they give you a full 360-degree view of a business and whether or not it's worth owning. Up next, we'll zoom in on each one, starting with the income statement, and show you exactly what to look for inside the numbers. All right, let's dig into the first and most commonly referenced of the three financial statements, the income statement. This is where we get a direct look at a company's ability to generate profit over time. Most income statements cover either a quarter or a full year, and they walk us through the company's operations, from revenue all the way down to net income. Let's break down the core components one line at a time. At the top, we start with revenue, also known as sales or top line income. This is the total amount of money the company earned by selling its products or services during that period. A healthy company shows consistent year-over-year revenue growth, not just one great quarter, but a trend. However, revenue alone doesn't mean much if costs are rising faster than sales. Next, we subtract cost of goods sold, or COGS. These are the direct costs of delivering the product, things like raw materials, labor, or shipping. Revenue minus COGS gives us gross profit. And this is where we start to see the company's pricing power and production efficiency. We want to watch the gross margin, which is gross profit divided by revenue. A strong, stable gross margin usually indicates a well-managed business that can maintain pricing or keep costs under control. After that, we subtract operating expenses, which includes selling, general, and administrative costs, as well as R&D or marketing. What's left is operating income, also known as EBIT, earnings before interest and taxes. This tells us whether the company's core business, the thing it's known for, is profitable on its own. Finally, after deducting interest payments, taxes, and any one-time items, we arrive at net income, the bottom line. This is the number that gets reported in earnings headlines and is often used to calculate earnings per share, or EPS. But here's the key. EPS can be misleading. Now let's talk red flags. One of the biggest, revenue growth with flat or declining profit. That often means the company is discounting too aggressively or struggling with rising costs. Other red flags include large jumps in other income that boost profits artificially, one-time gains making the quarter look better than it is, EPS increasing while net income stays flat, likely due to stock buybacks. Always cross-reference EPS with actual profit and cash flow. If a company is aggressively buying back its own stock, the number of outstanding shares goes down, which can artificially boost EPs, even if net income is flat or falling. So how do we actually assess profitability? We look at three key margins. Gross margin tells us how efficiently the company produces its core offering. Operating margin reveals how well it manages all business expenses. Net profit margin shows how much money is left over after everything. Margins are just as important as growth. A company can have rising revenue but shrinking margins, and that's a warning sign. Lastly, in practice, you'll want to compare these numbers to other companies in the same industry and look at trends over several quarters. For example, if Apple's gross margin stays stable at 43% over 5 years, while a competitor drops from 40% to 28%, that gives you insight into competitive strength, efficiency, or product dominance. The income statement tells us a lot, but it's only the beginning. Up next, we'll move on to the balance sheet, where we'll examine how companies manage their resources, debt, and capital, and how that impacts long-term sustainability. Next up, we're diving into the second core financial statement, the balance sheet. Unlike the income statement, which tells us how much profit the company made over time, the balance sheet shows us the company's financial position at a single moment, usually the end of a quarter or fiscal year. It answers three big questions. What does the company own? What does it owe? And how much is left over for shareholders, known as equity? At the core of the balance sheet is this simple equation: assets equal liabilities plus shareholders' equity. Everything the company owns must be funded by either debt liabilities or investment from shareholders' equity. That's why it's called a balance sheet. The two sides always equal out. Let's break it into three sections. First, we have assets, what the company owns. These are split into current assets like cash, inventory, and accounts receivable, things that can be converted into cash within 1 year, and non-current assets like buildings, equipment, or intellectual property. You want to see a solid cash position and a healthy balance of current assets, especially if the company has short-term debt coming due. One red flag: when goodwill or intangible assets, like the value of past acquisitions, make up an unusually large portion of total assets. That can signal overpayment or inflated balance sheet values. Next, we have liabilities, what the company owes. These include current liabilities like accounts payable and short-term debt, and long-term liabilities like bonds or pension obligations. A company can have debt. That's not automatically a problem. The issue is when debt becomes unmanageable compared to cash flow, or when it starts to crowd out growth spending. We'll use ratios like debt to equity and interest coverage in later analysis to evaluate this. Finally, we arrive at shareholders' equity. This is what's left over after you subtract liabilities from assets. Think of it as the company's net worth, or what would theoretically be left if all debts were paid off. Shareholder equity also includes retained earnings, which are profits reinvested back into the company instead of paid out as dividends. If equity is shrinking year after year, it usually means the company is either losing money, paying out more than it earns, or writing down assets due to poor investments. Now, let's talk ratios. The debt to equity ratio tells us how leveraged the company is. A ratio below 1 is usually healthy, but it depends on the industry. Utilities and telecom companies often carry more debt. Tech companies usually less. The current ratio compares current assets to current liabilities. A healthy company typically scores 1.5 or above, meaning it can easily meet its short-term obligations. And the book value per share shows us the tangible value of each share if the company were liquidated. Let me give you a few warning signs. If goodwill or intangible assets account for half the balance sheet, be cautious. If cash is falling while short-term debt is rising, that's a liquidity crunch waiting to happen. And if equity is declining while debt is ballooning, that could point to trouble, especially if profits aren't growing fast enough to justify the leverage. The balance sheet is your test of stability. It's not as flashy as the income statement, but it shows you the foundation the company is built on. Strong balance sheets mean companies can survive downturns, invest aggressively in opportunity, and return value to shareholders consistently. Up next, we'll finish the course set with the cash flow statement, the most misunderstood but possibly the most important statement of them all. All right, we've covered the income statement and the balance sheet, and now we're heading into the most underrated but arguably most important financial statement of all, the cash flow statement. Here's why this matters. A company can report profits on paper, but if it isn't generating real cash, it can't pay bills, reinvest in the business, or survive downturns. That's why we say profit is an opinion, cash is a fact. The cash flow statement breaks into 3 key sections. Let's walk through each. First is operating cash flow. This tells us how much cash the company brings in from its core business activities. It starts with net income from the income statement, but then adjusts for non-cash items like depreciation and changes in working capital, such as accounts receivable or inventory changes. Why is this important? Because accounting profits don't always reflect cash. A company might report strong net income, but if it's not collecting payments, or it's burning cash to support growth, that will show up here. You want to see positive and stable operating cash flow. That's the engine of a healthy business. Next is investing cash flow. This section tracks money spent on long-term assets like equipment, property, or acquisitions. It's usually negative for growing companies, and that's okay. They're investing in their future. But if CapEx is rising quickly and revenue or free cash flow isn't keeping pace, it could be a sign the company is overbuilding or overcommitting. Ask yourself, is the company spending wisely or just chasing growth? Third, we have financing cash flow. This includes borrowing money, paying off debt, issuing or buying back stock, and paying dividends. This section tells you how the company is funding itself. Is it taking on debt to survive? The pattern of cash flow in this section can reveal a lot about leadership's confidence and strategy. Now let's talk about the star of this statement, free cash flow, or FCF. Free cash flow is calculated by subtracting capital expenditures from operating cash flow. In other words, it's the cash left over after maintaining and growing the business. This is the money a company can use to pay down debt, buy back shares, pay dividends, or pile up on its balance sheet. It's a core metric for long-term investors because unlike net income, FCF can't be faked. Strong, consistent FCF is a sign of a well-run business. Negative or declining FCF, even when earnings look good, is a red flag. Here are a few patterns to watch for. Healthy companies typically have operating cash flow that's greater than net income. They reinvest in CapEx when it supports revenue growth, and they use excess cash to reward shareholders, not just prop up a weak business. On the flip side, be cautious if operating cash flow is falling while net income is rising if capital expenditures are rising aggressively, but revenue isn't. And if the company is borrowing just to pay dividends or buy back shares. In summary, the cash flow statement shows you the reality behind the earnings. It tells you if the business model is durable, scalable, and disciplined, or if it's running on fumes and financial engineering. With that, we've now covered the full financial foundation. Up next, we move from the numbers to the narrative and talk about moats, management, and how to interpret the full picture when analyzing a business. We've looked at the income statement, the balance sheet, and the cash flow statement individually. But now we're going to pull them together and apply some of the most important tools in all of fundamental analysis, profitability, and quality ratios. These are the numbers that help us measure not just if a company is profitable, but if it's efficient, resilient, and well run. Let's start with the basics, margins. Margins are all about efficiency and pricing power. They show how much profit the company keeps at each level of the income statement. Gross margin is gross profit divided by revenue. It tells you how much is left after direct costs like materials and labor. High gross margin usually means the company has pricing power or an efficient cost structure. Operating margin takes it a step further. It includes SG&A expenses and tells us how well the company manages overall costs. Net profit margin is what's left over at the bottom line. This is the final profitability after taxes, interest, and all other expenses. For all three, consistency matters just as much as absolute numbers. Are the margins stable, improving, or shrinking? Shrinking margins, even with growing revenue, can be a sign of trouble ahead. Now let's get into the real heart of company quality. Return-based metrics. ROE, return on equity, tells us how much profit the company generates for every dollar of shareholder equity. It's a favorite of Buffett and other long-term investors. A solid ROE is usually above 15%. ROIC, return on invested capital, is even better. It shows how efficiently the company turns capital, both debt and equity, into profits. A ROIC over 10% consistently is a strong sign of moat durability and management quality. Then we have ROA, return on assets, which shows how well the company uses everything it owns to generate income. Here's the key idea. High returns on capital mean the company doesn't just grow, it compounds. Next, we look at cash flow-based quality checks. Free cash flow yield is free cash flow divided by market cap. A high FCF yield may suggest the company is undervalued, or that investors aren't fully pricing in the cash-generating ability of the business. FCF conversion, free cash flow divided by net income, shows how well the company turns accounting profit into real cash. If earnings go up, but cash doesn't, that's a red flag. And finally, interest coverage, which is EBIT divided by interest expense, tells us how easily the company can cover its debt payments. A ratio above 3 is typically considered safe. Let's talk about what great companies look like on this front. You want to see strong and stable margins, especially during tough years. ROIC and ROE well above industry averages. Positive and growing free cash flow. High FCF yield that isn't just driven by a falling stock price. And clean capital structure and strong interest coverage. These are the compounders, companies that manage capital wisely and generate more value from every dollar invested. On the other hand, here are some red flags. Margins shrinking faster than revenue is growing. ROE that looks good but is only high because the company is over-leveraged. Free cash flow dropping even as earnings rise. That could signal accounting games. Or an FCF yield that looks high because the stock price is falling, not because the cash is strong. Always cross-check these ratios with trends, competitors, and other statements. Bottom line, revenue tells you scale. Margins tell you discipline. Returns tell you quality. Use these ratios to compare companies, spot winners early, and avoid value traps dressed up as cheap stocks. In our next slide, we'll look at how to identify fundamental red flags, the warning signs that often go unnoticed until it's too late. So far in this lesson, we've focused heavily on the numbers: revenue, cash flow, profit margins, debt, and ratios. But now we shift into something just as important and often more powerful over time, a company's competitive edge, also known as its economic moat. Warren Buffett popularized the term moat as a way to describe a company's ability to defend its business, just like a castle protects itself from invaders. A moat is what allows a business to raise prices, keep customers, and outperform competitors year after year. Without it, any success is temporary. With it, the company can compound earnings and investor returns for decades. Let's talk about why moats matter. Companies with wide moats don't just survive. They thrive in tough environments. They maintain pricing power, defend their market share, and usually operate with stronger margins and returns on capital than their competitors. From a financial perspective, moats show up in consistently high return on invested capital ROIC, strong gross and operating margins, low customer churn, and stable or rising profits, even in economic slowdowns. There are several different types of moats, and understanding which type a company has can help you evaluate its long-term durability. Here are some examples. Brand power, think Apple or Coca-Cola. Their brand creates emotional connection and allows them to charge a premium, even if competitors offer similar products. Cost advantage, Walmart and Costco are classic examples. Their massive scale allows them to offer lower prices and still maintain profitability, which new entrants simply can't match. Network effects, platforms like Visa, Airbnb, and Meta become more valuable as more people use them. Users attract other users, and that flywheel makes it extremely hard for competitors to catch up. Switching costs. Companies like Adobe or Salesforce lock customers into ecosystems that are costly and time-consuming to leave, which gives them pricing power. Intellectual property, patents, proprietary technology, or trade secrets can block new entrants from replicating what companies like Pfizer or Tesla have built. In regulatory barriers, some industries, like utilities or defense, have enormous legal hurdles. That regulation acts as a moat by keeping out competition. Now, how do you actually evaluate whether a company has a moat? Here are a few questions to ask. Can a competitor easily replicate this business? If they cut prices, would customers switch? Does the company raise prices without losing customers? Has it maintained high returns on capital for 5 or more years? These are clues that you're looking at a durable business. From a numbers perspective, you want to see ROIC consistently above 10% stable or improving operating margins, recurring revenue, or low customer churn platforms, brand loyalty, or product ecosystems that are hard to escape. On the flip side, even great moats can erode. Here are a few moat decay warning signs to watch out for: margins starting to shrink, customers leaving for cheaper or better options, new tech disrupting the industry, lawsuits, regulation changes, or loss of patents. In closing, I'll leave you with this: a moat is what turns a good business into a great long-term investment. A company with a real moat can protect its profits, dominate its niche, and scale up without being eaten alive by competition. In fact, many of the best investments of the last 30 years, from Amazon to Google to Microsoft, were obvious only in hindsight because of their defensive advantage, not just their revenue growth. Next, we'll explore a closely related topic: evaluating management. Because a wide moat means nothing if the people running the company don't know how to defend it. We've talked about profitability, cash flow, balance sheets, and competitive advantages, but none of those things matter if the people running the company don't know what they're doing. This brings us to one of the most underrated but most important pieces of fundamental analysis: evaluating management. Why does this matter? Because great businesses can fail under poor leadership, and average businesses can become exceptional if the right people are at the helm. When we evaluate management, we're asking, who's steering the ship? Do they make smart capital decisions? Are they aligned with shareholders? And can they guide this company into the future, not just manage the present? Let's break this down into 3 categories: capital allocation, insider ownership, and communication. First, capital allocation. Every dollar of profit a company makes has to go somewhere, reinvested into the business, used to pay down debt, paid out as dividends, or spent on acquisitions or buybacks. Smart leadership knows how to deploy capital strategically, not emotionally. Some key things to look for: do they reinvest into high return projects like product development or margin expansion? Do they buy back stock only when it's undervalued? Or are they just doing it to prop up EPS? Are dividends paid consistently and sustainably? And are acquisitions adding value or just driving growth at any cost? Poor capital allocators burn cash. Great ones compound shareholder value. Second, insider ownership. We want to know, Do executives have skin in the game? When CEOs, CFOs, and board members own significant stakes in the business, their incentives are aligned with shareholders. They think long term, avoid reckless risk, and take accountability. On the other hand, if you see executives dumping shares after short-term rallies, heavy dilution due to excessive stock-based compensation, or leadership constantly shifting strategy or guidance, those are red flags. Always ask, are they acting like owners or renters? Third, look at communication. This one's simple but powerful. When you read shareholder letters or listen to earnings calls, are they clear? Do they admit mistakes? Do they guide conservatively or hype with no substance? You want leaders who are strategic, steady, and transparent, not ones chasing short-term sentiment or masking poor execution with jargon. Some of the best management teams, like Satya Nadella at Microsoft or Jensen Huang at NVIDIA, built their reputations not just by growing revenue, but by communicating a clear long-term vision and executing with consistency. Here are a few red flags to watch for. Aggressive earnings adjustments, like adjusted EBITDA with no explanation stock buybacks. At overvalued prices, constantly shifting guidance or business models, defensive tone during Q&A sessions, high executive turnover, or sudden exits. In contrast, great management teams reward shareholders through smart compounding. They speak plainly and consistently, stick to a long-term roadmap, and act like stewards of the business, not hype machines. So here's the final takeaway. A company's financials reflect its past, but management determines its future. If you can find a business with strong financials, a durable moat, and a leadership team that acts with discipline and vision, that's a setup for serious long-term success. Coming up next, we'll pull everything together with a case study framework you can use to apply what you've learned and start developing your own investment thesis. All right, by now you've got the tools to evaluate a company's financials, its competitive edge, and its leadership. But here's the truth. Even great-looking businesses can have problems hiding beneath the surface. That's why we're going to close this core section with one of the most practical investor skills, spotting red flags. Let's start with one of the most common, the earnings versus cash flow gap. Sometimes companies will report strong net income, but if you look at their operating cash flow, it's falling. That's a huge warning sign. Why? Because net income can be manipulated through accounting, deferring expenses, recognizing revenue early, but cash flow doesn't lie. If earnings are rising but cash isn't, something doesn't add up. And if free cash flow is negative for multiple years while net income is high, that's another red flag. It could mean the company is spending heavily just to keep things afloat or masking issues through aggressive accounting. Next, look at margin compression. If revenue is growing, but gross margin or operating margin is shrinking, that means costs are rising faster than sales, or pricing power is slipping. It could be competition, inflation, or poor cost control. A healthy company maintains or improves margins as it scales. Shrinking margins mean shrinking efficiency. Always pair margin analysis with ROIC and free cash flow trends to get the full picture. Another one to watch for, one-time charges that aren't one-time. Be cautious of companies that constantly report adjusted EBITDA or non-GAAP earnings. If they're always excluding stock comp, restructuring costs, or asset write-downs, that's a sign management is trying to paint a rosier picture. One-time items that show up every quarter aren't one-time. They're a pattern. Now let's talk about the balance sheet. A sudden spike in goodwill or intangible assets after a big acquisition can be a warning. It usually means the company overpaid, hoping to buy growth. If goodwill keeps growing but revenue and earnings don't, that's a red flag. Also, if goodwill and intangibles make up more than 40% of total assets, start asking, what are they really worth? Then there's debt and liquidity stress. Look for rising debt without corresponding growth in income or assets. Interest coverage dropping below 2, meaning the company may struggle to service its debt. Or current liabilities exceeding current assets, a sign of short-term cash crunch risk. Leverage isn't bad on its own, but it's dangerous if it's growing faster than cash flow. You also want to watch for how management uses capital. Look for frequent stock dilution, especially if the company isn't growing profits. Share buybacks at high prices or funded by debt, which destroys value. And executive pay packages that rise even as the stock or earnings lag. That's a sign that leadership may be enriching themselves while shareholders lose out. And finally, pay attention to behavioral red flags. Do executives speak clearly and honestly during earnings calls? Is there high turnover in leadership positions? Are they frequently changing guidance without explanation? Are insiders selling stock consistently with no purchases? These signs won't show up on a financial statement, but they're often the smoke before the fire. Here's the bottom line: numbers tell a story, but when that story starts to feel inconsistent, it's time to pause. Red flags don't always mean sell immediately, but they should always trigger further investigation. The best investors don't just chase profits, they avoid problems. Spotting red flags early can protect you from drawdowns, dilution, or even fraud. In our next section, we'll take everything you've learned and apply it through a guided case study framework so you can begin evaluating companies with real confidence. We've just covered a huge amount of ground, from financial statements and profitability ratios to moats, leadership, and red flags. Now it's time to put it all together into something actionable. This is your mini case study framework, a structured way to evaluate any public company using fundamental analysis. Whether you're researching Apple, Home Depot, or a niche growth stock, this framework helps you ask the right questions in the right order. Let's break it down step by step. Step 1, business overview. Start by asking, what does the company actually do? Who are its customers? What market does it serve? Is it business to business or B2C? Are they building hardware, selling software, providing services, or moving physical goods? Understanding the business model helps you frame every other part of your analysis. And it's often helpful to compare it to a direct competitor to highlight strengths or weaknesses. Step 2, financial statement review. Now go straight into the numbers. Look at each of the 3 core financial statements over a 3 to 5 year period, not just a single quarter. From the income statement, check for top line revenue growth, margin stability, and EPS trends. On the balance sheet, assess asset quality, debt levels, and liquidity. In the cash flow statement, see if the business consistently generates free cash and how much they spend on CapEx. You're trying to answer, is this business growing and is it growing healthily? Step 3, profitability and quality ratios. Once you've got the raw numbers, convert them into quality signals. Are margins expanding or shrinking? Is ROIC above 10% and stable? What's the company's free cash flow yield? Can they cover their debt with cash flows, or are they stretched thin? Strong businesses generate efficient profits, not just big ones. Step 4, moat and competitive advantage. Zoom out and look at the company's strategic positioning. Do they have a moat, a network effect, brand power, high switching costs? If they do, that should show up in the numbers. High ROIC, stable margins, predictable earnings. If not, they might be vulnerable to pricing pressure, new competitors, or commoditization. Step 5, management evaluation. This one is more qualitative, but equally important. Are leaders allocating capital intelligently? Do they own a meaningful number of shares, or are they just drawing a paycheck? When things go wrong, do they communicate with clarity and take responsibility? Read shareholder letters. Listen to earnings calls. Trust your gut. Vague defensive leadership is a red flag. Step 6, red flag scan. Before you make any judgments, run through a quick checklist of potential warning signs. Is net income rising while cash flow falls? Are goodwill and intangible assets ballooning? Are they issuing lots of stock or taking on too much debt? If anything feels off, pause, recheck your assumptions. Step 7, investment summary. Now, summarize your view. Ask yourself, is this a quality business? Is it financially healthy? Does it have a moat? Is management trustworthy? And finally, is it reasonably valued? You don't need every box checked. But if 4 out of 5 are strong and the price is fair, you might be looking at a long-term winner. So here's your challenge. Start applying this framework on real companies. Pick one you're curious about. Use the tools. Trust the process, because once you learn how to read the story behind the numbers, you'll never look at a company the same way again. Before we dive into the assignment itself, I want to start by highlighting a few core readings that will support your work this week. These texts aren't just background, they're the foundation of how real investors think and evaluate businesses. First, from our core textbook, Essentials of Investments by Bodie, Kane, and Marcus, focus on chapter 18, 19. We'll review how to interpret financial statements, evaluate accounting quality, and apply common ratios like ROA, and interest coverage. These chapters give you a technical textbook grounding in the tools we're using, then move on to Aswath Damodaran's The Little Book of Valuation, especially the chapters on financial statements and free cash flow. Damodaran explains why free cash flow matters more than earnings and how to think about valuation through a long-term lens. Next is Howard Marks's The Most Important Thing. Look at the chapters on understanding risk and avoiding investment pitfalls. Marks will sharpen your awareness of things that don't show up in the numbers, like volatility, fragility, and narrative risk. And finally, we have Philip Fisher's Common Stocks and Uncommon Profits, where his 15 points checklist pushes you to evaluate leadership, innovation, and scalability. Fisher's lens is qualitative, but it's grounded in real-world investing. These readings are meant to help you go beyond surface-level analysis and develop conviction through clarity. Now let's talk about your assignment. Your task is to select a publicly traded company, any business you're curious about, and walk through the full analysis framework we covered today. Start with a company snapshot. What do they do? Who do they serve? What industry are they in? What's their competitive landscape? Then review the financials over the past 3-5 years. Look at revenue and net income growth, margins, and consistency. Do the numbers tell a steady story, or are there surprises? Next, examine the balance sheet. What's their liquidity position? How much debt are they carrying? Are there any signs of stress, like rising goodwill, weak current ratios, or deteriorating working capital? Then calculate your profitability and quality metrics, ROIC, ROE, FCF yield, and FCF conversion. These numbers tell you how well the company turns capital into real shareholder value. From there, evaluate their economic moat and leadership. What makes this company durable? Are they defensible? Is management aligned with shareholders and thoughtful with capital? Run a red flag scan. Check for a mismatch between earnings and cash flow, recurring one-time charges, margin compression, or excessive dilution. Finally, wrap it all up. Would you invest in this business, and why or why not? The goal here isn't perfection, it's process. Show that you can evaluate a business like a long-term investor with structure, skepticism, and strategy. And once you've completed your analysis, we'll shift to something a little different, our Beyond the Charts segment, where we focus not on financial data, but on how to think like a long-term operator in the market. We'll end today's session by zooming out from cash flow and capital efficiency and focusing on the real edge, your mindset. This is our Beyond the Chart segment, where we step into the philosophical and psychological side of investing. Because let's be honest, two people can look at the exact same set of financials, and one will panic while the other builds conviction. What separates them isn't knowledge, it's mental discipline. This week, I've selected 3 powerful readings to help us reflect on that. First, we have The Art of War by Sun Tzu, an ancient text on strategy and positioning. We're looking specifically at the chapters on strategic offense and weaknesses and strength. One of my favorite lines, victorious warriors win first and then go to war. That's the investor mindset. You don't wait for the headlines or the price breakout. You build your position early because you understand the fundamentals before the crowd reacts. In markets, preparation wins. Not speed, not aggression, but preparation. Next, we have Anti-Fragile by Nassim Taleb, a modern classic on how some systems actually thrive under pressure. Focus on Chapter 5, where he outlines the barbell strategy, and Chapter 13, where he criticizes people who confuse academic theory for reality. Taleb's core idea is this: anti-fragile systems benefit from disorder. As an investor, this means you shouldn't just tolerate volatility. You should design your approach to benefit from it. This is especially true when rotating into sectors or betting on mispriced assets. Markets are never stable, and you shouldn't expect them to be. Finally, we turn to The Obstacle is the Way by Ryan Holiday, which brings in the Stoic mindset. We're looking at chapters 1 through 2 and chapter 9. The key quote, "The impediment to action advances action. What stands in the way becomes the way." For long-term investors, discomfort is part of the process. Valuations may dip. News cycles may shake your conviction. But that doesn't mean your thesis is wrong. It might mean you're early. The obstacle is not the signal to run. It's often the confirmation that you're on the right path. So here's your reflection prompt for the week. How does this reading challenge or refine your view of what it means to be a good investor? I want you to go deeper than skills. Think about timing, temperament, risk, conviction, humility. What kind of thinker do you need to be to evaluate a business and hold your position when things get tough? Post your reflection in the Discord thread. We'll revisit it at the start of next week's session. Thanks for leaning in this far, and I'll see you for week 9. Thanks again for sticking with me through week 8 of Finding an Edge in the Markets. We covered a lot today, from income statements and balance sheets to return metrics, red flags, and what really defines a great business. But more importantly, we explored how your mindset, discipline, and decision-making are just as critical as your spreadsheet. If you found this session helpful, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next drop. And if you're part of the iSpy Academy Discord, don't forget to post your reflection from the Beyond the Chart segment, submit your assignment using the case study framework, ask your questions, or share your insights in this week's thread. Now, next week, we make a major pivot. We move from fundamentals to technicals. You'll learn how to read charts, understand price action, and start developing your own trading setups using technical analysis. We'll explore things like support and resistance trend structure, candlestick patterns, and how to combine indicators with volume for confirmation. It's going to be hands-on, visual, and practical. Whether you're a long-term investor trying to time entries or a trader looking for edge, I'll see you in week 9. Introduction to Technical Analysis. Until then, stay sharp, stay patient, and remember, conviction is built, not borrowed. As always, if you have any questions, submit them using the QR code on the screen. And don't forget, if this content is helping you build clarity and confidence in your trading or investing, like, comment, and subscribe. You can find links to our Discord group, recommended tools, and all course materials in the video description below.